Welcome to The Working Thesis. I am Maya.
And I am Theo. We are looking back at the week that ended July 17th, 2026. This was the week the bill finally came due for semiconductor valuations, even as the strongest public evidence still pointed to robust artificial intelligence demand.
It really was a breathtaking sequence of events. We saw a near 10% weekly loss in some of the most critical semiconductor indices. For months, the market has been entirely willing to look past any valuation concerns because the fundamental growth story was so overwhelmingly strong. But the earnings clock is now ticking louder than ever.
Exactly. The primary question the market has to answer over the next few weeks is no longer just about the pace of the physical build-out. It is asking a much harder, more structural question: whether this massive, debt-heavy AI Capex is actually going to translate into durable revenue, real margins, and acceptable free cash flow. We are moving from the narrative phase of the cycle into the math phase of the cycle, and the math requires absolute precision. Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
Let us look at the weekly scoreboard, because it really was a tale of two entirely different markets. The semiconductor indices took a historic, punishing hit. The SOX was down 10.24% for the week, and the SMH dropped 8.92%.
The broader technology sector felt that weight as well, with the XLK down 5.48%. Looking at the major averages, the Nasdaq as a whole dropped 2.9%. The S&P 500 fell 1.55%, and the Dow eased just 0.93%.
But beneath that surface, much of the relative move looked like rotation rather than a uniform withdrawal from risk. Software held up quite well, with the IGV up 0.42%. Financials through the XLF gained 0.99%. Real estate via the XLRE rose 2.18%, and energy through the XLE jumped 4.72%. Meanwhile, the VIX spiked 24.88% as volatility returned with a vengeance.
The dispersion was wild. Apple rose 5.84%, and Microsoft gained 2.26% as relative megacap refuges, while investors reduced hardware exposure. But in semis, Micron fell 13.31%, SanDisk dropped 29.29%, and Western Digital lost 18.09%. Equipment makers like Lam Research dropped 10.57%, and Applied Materials fell 12.09%. Meanwhile, cybersecurity showed notable relative strength, with CrowdStrike gaining 8.49%, Okta adding 7.73%, and Palo Alto Networks rising 10.05%. It was a very specific unwinding of hardware premiums.
To understand how we got there, let us compress the 5 days into 90 seconds. Monday opened with Korean margin pressure and a post-listing unwind in SK Hynix after its record Nasdaq ADR offering had priced the previous week. Tuesday brought cooler consumer inflation and record bank profits, giving the broader market a temporary relief rally.
Wednesday delivered cooler producer inflation and a major guidance increase from ASML, but CXMT's $8.55 billion offering sharpened concern about future conventional DRAM supply. Thursday brought TSMC's record quarter and the Bank of Korea's 25 basis point rate increase to 2.75%. The KOSPI fell 6.37% as leverage and tighter financial conditions collided.
Then Friday carried the shock into Taiwan. The TX fell 6.47%, its largest point decline in history, while local TSMC shares dropped 7.29%. That regional liquidation spread through U.S. semiconductors, even though the underlying earnings evidence had not suddenly reversed.
It was a brutal 5-day arc. During a forced unwind, immediate financing and margin requirements can dominate fundamental valuation. The offering itself was not new that week. What mattered was how its enormous $26.5 billion supply, crowded positioning, and existing leverage shaped the post-listing unwind.
That brings us to what actually broke. The tape briefly treated the sell-off as evidence that fundamental AI demand had hit a wall, but the observable mechanics point more directly to valuation, crowding, and leverage.
That distinction matters. Semiconductor ownership had become unusually concentrated, so the Korean and Taiwanese shocks reached a market with little room for disappointment. Forced selling then spread across liquid, profitable names, as well as the more cyclical parts of memory, storage, optics, and equipment.
When a sector is priced for near-perfect execution, even modest tightening can trigger a cascade. This does not prove every semiconductor was fairly valued, and it does not settle the return on Capex question. It only tells us that the strongest public demand evidence remained intact while the market structure broke around it.
Which perfectly transitions us to the proof that demand was still there. TSMC reported their second quarter, and US dollar revenue was $40.2 billion, up 33.7% year-over-year, and up 36% in new Taiwan dollars.
Their margins were exceptional. Gross margin hit 67.7%, and operating margin was 60.3%. They also outlined a massive 2026 Capex plan of $60 billion to $64 billion, with their total U.S. commitment reaching roughly $265 billion. They guided third quarter revenue to between $44.6 billion and $45.8 billion, with a slightly lower gross margin guide of 65 to 67%.
Some headlines focused heavily on that lower margin percentage, but let us do the math. For the second quarter, $40.2 billion times a 67.7% margin is about $27.2 billion in gross profit. For the third quarter midpoint of $45.2 billion times a 66% margin, we get roughly $29.8 billion. That is roughly a 9.6% sequential increase in absolute gross profit dollars, despite the lower margin percentage.
Management also mentioned visibility toward 2029 and 2030, which we should clarify is an outlook based on customer forecasts, not a legally contracted backlog. ASML also validated this. They posted 9.3 billion euros in Q2 sales with a 54% gross margin and 2.9 billion euros in net income. They raised their 2026 sales guidance to 43 billion to 45 billion euros and gross margin guidance to 54 to 56%.
So the demand is clearly real. But that brings us to the core issue going into earnings season, which is the packed restaurant problem.
I absolutely love this analogy. Walk us through how a hot pot restaurant explains the current dynamic in the AI market.
Imagine you walk by a brand new hot pot restaurant in the center of town. There is a line out the door. Every table is completely packed, and diners are eating frantically. That packed dining room is your AI usage. The demand is undeniable and highly visible to everyone walking by. But as an investor, a full dining room does not automatically mean a good financial return.
Exactly. What if the owner borrowed heavily at high interest rates to open 50 new branches all at once? And to keep those tables completely full, they are steeply discounting every meal? The kitchens and the physical buildings represent the sprawling data centers. The rent, the debt, and the electricity are the crushing Capex and financing costs. The diners are the enterprise AI usage.
So the cash register at the front of the restaurant has to collect enough actual revenue and free cash flow to pay off all that accumulated debt. If the owner is just subsidizing meals to keep seats full, the business eventually collapses under its own weight. The market knows the restaurants are full, but investors are now walking up to the front counter and demanding to see the cash register receipts.
And while the equity market wrestles with that corporate return problem, the macro backdrop provided a very mixed signal this week. The Federal Reserve released its July monetary policy report, holding the target range steady at 3.5 to 3.75%. They explicitly noted that inflation remains elevated, though the labor market is stable.
But the data underneath was remarkably contradictory. We had May PCE at 4.1% year-over-year, with core PCE at 3.4%. But then June, CPI came in at negative 0.4% month-over-month, bringing the year-over-year to 3.5%. Core CPI was flat on the month and 2.6% year-over-year. June PPI was also negative 0.3%.
That looks like wonderful disinflation. But initial claims were incredibly resilient at 208,000. The Philly Fed Manufacturing Index came in at a surprisingly strong 41.4. Import prices actually rose 0.3% when they were widely expected to decline. Michigan consumer sentiment was at 54.4, and housing permits dipped 3% to 1.367 million.
We have clear goods and energy disinflation clashing directly with resilient economic activity and sticky imported inflation. It is a genuinely mixed picture, which is exactly why we cannot confidently forecast their next rate decision. The market wants certainty, but the Fed is staring at a deeply conflicted dashboard.
That mixed macro picture leads directly into the currency and bond markets. The natural question during a market panic is whether the dollar is strengthening, but the DXY index actually fell slightly, moving from 100.97 down to 100.75, which is a 0.22% decline for the week.
And the 10-year Treasury yield eased about 3 basis points, moving from 4.569% down to 4.541%. The dollar is historically strong in real terms, but it did not break out higher despite the equity sell-off. What did move dramatically was oil. Front-month WTI rose roughly 14.5 to 15.5%, ending near $82. The USO oil fund rose 14.04%.
That was driven heavily by the confirmed U.S. and Iran escalation in the Middle East and the associated threats to crucial shipping routes. We are not speculating on a broader invasion, but the geopolitical risk premium in the oil channel is undeniably back.
And that oil channel feeds directly back into the dollar. The US dollar will likely stay firm if the Fed maintains current rate differentials and if energy inflation persists. But it could easily soften if the disinflationary trends broaden out, if domestic growth slows, or if safe haven flows systematically diversify away from US assets.
So there are two competing routes. An oil shock can support the dollar through inflation and a firmer Fed path, while a broader loss of confidence in growth or fiscal durability can eventually push capital toward other reserve assets. This week's tiny dollar decline settles neither argument. It simply tells us the risk-off move was not a classic one-direction rush into dollars. Speaking of safe haven flows, gold futures actually fell about 2.08% this week, and the GLD ETF dropped 2.28%.
A softer weekly DXY and a slightly lower 10-year yield would normally remove two headwinds for gold. But intraday rate and dollar changes, together with broader cross-asset deleveraging, likely contributed to the early week decline. Gold recovered on Friday as geopolitical risk broadened.
That brings up the question of seasonality. Should the usual late summer and early autumn physical demand pattern matter this year, or have June's dip purchases and the unusual macro backdrop shifted the calendar? Historical seasonality is a tendency, not a hard rule.
Exactly. Gold often receives seasonal physical demand support later in the summer and autumn, but public primary source evidence is simply not strong enough to promise a guaranteed September rally. Shifts in real yields, the US dollar, and sudden geopolitics can easily overwhelm the calendar.
Seasonality may open a window. It does not push the price through it. A constructive second half would still need help from some combination of softer real yields, a less dominant dollar, persistent official demand, or geopolitical hedging. If the Fed stays restrictive while energy keeps inflation elevated, the calendar alone may not be enough. We also need to look at the official sector. It is only July 18th, so we cannot claim that second-half central bank buying has already accelerated. But from the first half, we know the People's Bank of China bought 15 tons of gold in June.
That was its largest monthly addition since 2023, extending a remarkable 20-month buying streak. For the first half, their additions totaled about 40 tons, bringing official holdings to roughly 2,346 tons. Other notable buyers included Poland, Uzbekistan, and Kazakhstan. Singapore also bought about 4 tons in May.
However, Turkey and Russia were net sellers, so the flow is not completely universal. But a recent World Gold Council survey showed a record 45% of surveyed central banks plan to increase their own gold reserves over the next 12 months, and an incredible 89% expect global official gold reserves to rise.
We have to wonder if that aggressive June dip buying might have front-loaded some of the demand, which could potentially delay a later seasonal impulse. We do not have the data to prove that yet, but it is an interesting hypothesis that we are watching closely.
Now we must look ahead. Wednesday, July 22nd, is the first major earnings test. Before the market opens, we will hear from GE Vernova, where the relevant evidence includes power and grid backlog, gas turbine capacity, margins, free cash flow, and actual delivery timing. Without power, there is no AI scaling.
After the market on Wednesday, Alphabet reports. We will watch Google Cloud growth, AI monetization, Capex, margins, and free cash flow. The reported Gemini delay is important execution context, but it is not a long-term prediction. Tesla also reports Wednesday evening with focus on auto gross margin, free cash flow, Capex, energy storage, and spending on AI and robotics.
We also hear from ServiceNow, where metrics like subscription growth, current remaining performance obligations, AI product attach rates, monetization, and margins matter heavily to software valuations. They are a bellwether for enterprise IT spending.
Finally, IBM reports Wednesday after falling 26.04% for the week. The tape treated the preliminary miss as a broader software warning, yet IBM software grew about 5%. The weakness centered on mainframe, infrastructure, and Capex timing. The full results will let us examine that composition and the company's free cash flow.
Moving to Thursday, July 23rd and Friday, July 24th, the focus shifts to cyclicals, power infrastructure, and macro. After the market on Thursday, Intel reports where it is all about foundry progress, gross margin, Capex, and free cash flow. Their turnaround is a massive capital sink.
Also on Thursday, we hear from Freeport-McMoRan, Cleveland-Cliffs, SAP, and Newmont. We will be checking those reports for copper and industrial demand, the state of the steel cycle, cloud software resilience, and gold mining costs. They are perfect barometers for the physical economy.
Then on Friday, July 24th, NextEra Energy reports before the market. This is absolutely critical for the AI infrastructure thesis. We need to hear about power demand, their generation and storage pipeline, Capex, financing costs, and regulatory execution.
Friday also brings a heavy macro slate, with the flash PMIs, durable goods orders, and new home sales giving us a real-time read on whether economic activity is structurally slowing down or holding steady against these very high interest rates.
The next major evidence arrives on July 29th when several Capex heavyweights report. After the market, we get Microsoft, Meta, Lam Research, and Qualcomm. We also hear from Vertiv before the market opens.
The metrics here are the absolute foundation of the AI narrative. For Microsoft, it is Azure and AI revenue, Copilot monetization, and data center Capex. For Meta, it is how their AI investments are returning value through advertising, along with their massive Capex spend.
For Lam Research, the relevant evidence is wafer fab equipment and memory orders. For Vertiv, it is the power and cooling backlog. And for Qualcomm, it is the edge AI mix, margins, and free cash flow. Together, these reports will provide one of the cleanest tests yet of the Capex return debate.
To properly grade all these reports, we have built a specific tell sheet. Number 1, Capex growth versus prior guidance. Are they spending even more? Number 2, AI and cloud revenue growth with specific evidence of actual monetization, not just pilot programs. Number 3, free cash flow conversion and depreciation commentary.
Number 4, gross margin direction, and whether aggressive overseas expansion or startup dilution is impacting it. Number 5, the power, grid, and cooling backlog and realistic delivery schedules. Number 6, memory and equipment order breadth, specifically the mix between HBM and conventional DRAM.
On that note, CXMT recently had a base IPO of about $8.55 billion, giving them roughly a 7.7 to 8% DRAM revenue share. Their credible near-term threat is in conventional DDR and LPDDR memory, not frontier HBM. That medium-term supply could eventually restore cyclicality to ordinary DRAM.
Number 7, any restructuring of take-or-pay contracts or long-duration capacity commitments. And finally, number 8, whether the semiconductor tape forms a multi-day base and volatility compresses, which is a pure observation of market mechanics, not a prediction.
These details matter more after a valuation shock because the market's tolerance has changed. When expectations are modest, a small guidance miss can be absorbed. When valuations already assume near-perfect execution, even an unchanged Capex plan paired with weaker cash conversion can force investors to recalculate the whole path of returns. That is why the same earnings number can produce a very different reaction in July than it would have produced a few months earlier. As we wrap up, there is a broader risk lesson in this week. It is entirely possible for a long-run thesis to be correct, while a highly leveraged expression of that thesis still suffers a severe loss.
Excessive leverage or concentration can shorten the holding period until a routine drawdown becomes a forced exit. A correct thesis can fail the holder when financing terms expire before the evidence arrives.
Market plumbing does not care how persuasive the long-term vision is when a margin call arrives on Tuesday morning. Position structure, financing, and time horizon determine whether an investor survives long enough to see the thesis tested.
And that leaves us with the genuine open question for the weeks ahead. The hot pot restaurant is packed. The demand for the silicon and the data centers is real. But the bill for building it all is coming due.
So the open question is simply this. Is this debt-heavy AI Capex actually translating into durable revenue, resilient margins, and acceptable free cash flow? We will not know the answer until we see the Capex growth versus guidance, the real monetization evidence, and the power delivery schedules. We are all waiting on the actual receipts to be printed and handed to the market before we can make a final judgment on this cycle.
We have to remain humble, watch the data closely, and let the companies prove it to us. Thank you for reasoning through this with us. We will see you next week.
Laughs. Thanks, everyone. Take care.
That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.